Hey everyone, it's Imran back again after the long weekend. Last week it was pretty evident that the bears were capitulating. We saw expiry flows, a lot of call option buying, pushing the markets up to new highs for the year, only to see spots start to fade back again after a lot of those options expired. Obviously, the morning is when a lot of the S&P expires, and then throughout the day you get the single stocks and the ETFs expiring as that large quad witching, as it's called, rolls off, because futures also expire in the S&P on June. Now, the systematic community, as you can see from this chart by Deutsche, has been slowly getting longer all year. Obviously, these are the trend following types, the vol control types. So if we look at kind of how that positioning has evolved, you see the blue line here from lows kind of back end of last year did basically find themselves moving up along there. Now, the green line, on the other hand, is discretionary positioning, and that's basically money managers who don't just price chase. They probably analyze a bit more the fundamental and the macro, and they were quite happy to sit on the sidelines because there's a lot of bearish narratives out there, whether it was the banking crisis, the recession, whatever, and they were waiting for that to play out, thinking they're going to get equities cheaper once that happens. Now, in the last month, that dynamic has clearly changed. You can see the green line has really shot up, right? So you can see here, green line much higher, popping to catch up to the blue line. So that's like relatively bearish positioning in the discretionary community suddenly being forced back in. So probably more because they just couldn't take the pain anymore. But I don't think it's because their fundamental view has necessarily changed. Sure, we've had the AI growth story. Maybe that's improved the outlook longer term, but it's not like those AI related names are trading cheaply, especially the likes of Nvidia. So we think it's a bit more of a stop back into the market, people getting stopped in because they can't afford to not participate in any more upside from here, which is not really a healthy reason to buy the market. It's just that you haven't owned it. And then, sentiment surveys have flipped into bullish or greed, extreme greed territory again. So it does feel like a precarious spot to be long right now. We suspect that gravity does need to pull the market back down a bit. We think that push through 4,300 was a little bit too aggressive. So if we can get ourselves back to somewhere near 4,300, suck in some bears back into the game, I think then maybe we can rally again from there. But I just think that we need a period of consolidation. I think the time frame into month end kind of sets up well for that. And then maybe we're going to get another push basically once the next quarter begins. Okay. Looking at our dashboard, obviously a lot of markets were shut yesterday, and we used a lot of US ETFs as from our other asset classes. But in general, it was a quiet session. Europe and Asia drifting slightly, consolidating last week's gains. PBOC did cut the LPR, but in the 5-year, less than expected. You also had Goldman's cut their China growth target down, following on from what Nomura and UBS had already done. So in general, people are a little bit less bullish on China growth. And then looking at the dollar, that did stabilize after those falls last week. Aussie dollar also fell on RBA minutes, showing that it was a bit more finely balanced in terms of the hike that we got recently. In terms of skew, it's been hit very hard recently as bears capitulated, everyone reaching for upside protection rather than downside, taking it basically to the lows of 18-month range. We think this flow has reached an extreme last week. And that is normally indicative of some mean reversion to come. So we'd be looking for some mean reversion in skew there and a bit of a pullback back in the market as we think that went a bit too far. European vols, you can see they did bounce slightly here. So we've got, let me just highlight that there. So we've got half a vol pop in most European indices. How implied volatility trades this week, especially if the market moves lower, is going to be very telling. It's going to give us a read on what positioning looks like. We do suspect the market has got a fair amount of gamma down at 43.20 for that big call strike from the JP Morgan collar that everyone's aware of. But the question is, what are the offsetting positions against that strike? and therefore what is the net positioning like? And we're only really going to know that when we see how vol price action reacts if we move down there. So that's what we need to be watching. What does a fixed strike vol do in the next 2% lower from here? Does it catch a bid? Does it struggle? And that's going to tell us really what the net positioning looks like. And then carry wise, we can see carry's a lot more balanced in terms of lots of green, a fair amount of green, fair amount of red. So it looks like there's opportunities across all asset classes. There's opportunities from both the long and the short gamma side of things. All right. And now if we look at an asset that's kind of caught my eye recently, HYG. So a few weeks ago, we entered a trade on HYG called a calendar strangle, where we bought some short dated, we bought some calls and bought some puts, but they were different expiries. The idea was that we thought this triangle formation on the chart on HYG that was here, we were going to break out of that triangle and move materially in either direction. That's typically what you tend to see happen when triangles break. So we were expecting some sort of measured move, maybe up to 76 on the upside or down to 70, 72 on the downside. To be honest, that's not really materialized. So all that's really happened is we've had risk assets break higher. HYG has not been able to keep pace. It's just been a slow grind up and vol's got annihilated. And you can see vol here, the dots on this skew chart that we produce every week for our weekly subscribers. The vol's just been a straight line down over the last few months from a 13 level to now a sub 6 level. This is a 3-month vol, so 3-month vol's a little bit higher, but the 1 month is actually on a 5 handle now. So, you know, we think the vols are looking a bit low here. The skew's also flattened in HYG. So if this is a false break and we actually think about this sort of horizontal resistance as holding around 75.5, then we may well actually test back down. If risk assets do fall, some people speculating that all assets are going to go down together over the next few weeks. If we were to see that, bonds down and equities down, you're probably going to see HYG down as credit spreads widen a little bit as well. And you may get down to sort of 73 again in that sort of vicinity in HYG. We'd expect vol to have a reasonable pop if that was to happen. Okay, so we are thinking that HYG puts are offering decent value as that vol's just been absolutely oversold. Right, strategy compass kind of backing us up there in buy puts. Skews down here at the bottom of the range. Term structure is pretty flat, but has shifted lower over the last month. Carry's quite neutral, therefore options are holding their own in terms of what they're realizing. So a lot of things stacking up to say that buying outright puts is how you probably want to be biased on HYG if you are bearish near term for risk in general. Okay, that is it for today's trade idea. Thanks a lot, everyone, as always. Catch you all tomorrow. Cheers.